Hi everyone and welcome to the Everyman Investor. So in today's video, I'll be taking a look at fixed income investments. Now to be perfectly frank, this is not one of my favorite investments for a simple reason. I think that if you start young with a savings plan, you will get a greater yield given that the interest for savings plans are compounded. If you choose a variable surrender value or surrender duration savings plans. For fixed incomes in general, the interest is simple interest annually, and it usually generates pretty much lower returns than savings plans, except for the current environment whereby central banks all around the world are raising their interest rates, and that is why this has become quite a popular investment recently. Because as rates go above 4, even above 5% at times, you are getting a pretty decent yield for pretty low risk. Now, to understand how this works, we need to look at the rating for the investments. So this is from Investopedia, which basically gives you a rating of the risk of default for the bond or treasury bill, depending on what is the grading that is assigned to it by the various rating agencies, usually Moody's and S&P. So governments have a credit rating, as do companies. So for example, government bonds with the US currently are somewhere in the region of double A. They have been sort of downgraded, but it's still investment grade, which is low risk. Certain companies are at BB or C rating even, which basically means to say that they are very high risk of defaulting, but at the same time they usually pay a lot higher interest because of the risk you are taking in buying those bonds. Now, how does fixed income actually work? So to put it simply, you are the bank. So a company or government, you requires money. All governments and companies require money. All people require money, basically. And basically, in order to raise that money, they issue treasury bills or bonds to investors. And they have an interest attached to that treasury bill or bond. A lot of times it depends on the central bank interest rate at the time. And basically, they will pay you an interest for the duration of the product. So for example, if you buy a 10-year treasury bill, you have lent the government the money. Say you spend $5,000 on the treasury bills that you have bought, so the government gets $5,000 from you, and they'll pay you say 5% interest every year until the maturity at the end of your product duration. So you will get back your capital and your interest collected if held to maturity. And it is risk-free if the issuer doesn't go bankrupt, which is where the credit rating is very important, which is why I started with credit rating in the first slide. Okay, there are people who trade fixed income securities for capital gains. Now, how does this work? I'll be very honest with you, I have no idea how to do it, but I know how it works because I actually buy funds that have got holdings in bonds and treasury bills, and their net asset value is important to me because they pay a dividend based on net asset value. Okay, so this is for those who are interested in buying and selling for capital gains. In general, these are the pros. Okay, how it works is very simple. So you bought, say an investor buys a $10 bond at a yield of 4%, which gives him 40 cents per year per bond of interest. Now, at the time when he bought the bond, the interest rates from the central bank was 4%. However, during the course of that, say 1 year, central banks actually raised interest rates from 4 to 5%. Now, the next year, say this investor needs to get money because he wants to buy something important and big, and he needs to sell off that bond for cash. The next investor will, of course, want a 5% interest return because now central bank interest rates are 5%. So if he buys the bond that the initial investor bought, he buys it for $8, which means to say that the initial investor loses $2 on that bond, which is a 20% loss of capital, and the new investor actually gets it at $8, and at 40 cents per bond, it is still a 5% yield, which is what the central bank yield is now. Now, say for the next year, the central banks reduce rates from 5 to 4%. Now, this second investor can sell the bond now and can sell it for $10 because that will give the next investor a 4% interest, which means to say that the second investor actually is selling it for a 25% gain of the capital that he put in. So this is how trading of bonds works. And it is very, very important for bond funds because by buying and trading the bonds, they actually increase their net asset value. and from there they pay you your dividend. Now, for those of us who have no idea how trading works for bonds, which includes me, then the price volatility actually doesn't really matter if you're holding it to maturity. So how to invest in fixed income? So you can buy the government bonds or treasury bills yourself. You can subscribe when a new tranche is announced. So usually there will be an announcement, then you can go and subscribe to it, and then when it's oversubscribed, they'll close off the tranche, and then they'll sort of issue you your bonds or your treasury bills. I don't usually do this because this gives you basically the basic yield of whatever the central bank is paying at the moment in time. Now, corporate bonds are actually a lot more interesting because corporate bonds usually pay higher interest. So usually this is bought from either brokers or financial service firms. Some products actually require to be an accredited investor. You can look up what is the requirement for accredited investor. Basically, you need to be very rich, or you need to be making a very big salary, which I'm not making, and neither do I have the net assets to be considered an accredited investor, which is why I said this is something that I don't do. What I do is I buy a listed fund that invests in bonds. So basically, the fund will pay me the dividend based on net asset value of its investments. Given that corporate bonds and bills, treasury bills and government bonds are now yielding high yields, this is actually a good time to go in, because as the interest rates drop over the next few years, then the net asset value of the bonds and treasury bills will go up, as I mentioned how it goes up in my previous slide on trading on bonds. Or you can invest in a savings plan. So you start young, you invest in a savings plan that invests in bonds or treasury bills. Now then, to you, it's just a fire and forget investment, whereby you just hang on to it until your maturity or surrender for your savings plans. Now, for liquidity, I have no idea how liquid trading in bonds is, but I can tell you that for listed funds that are basically invest in bonds and give you dividends, the liquidity is not an issue. I have never had a problem buying. I have not sold, to be honest, because I plan to keep it for my retirement for the dividends. But from the volume it generates on a daily basis, yeah, it's not an issue getting rid of it at all. So in conclusion, now, the good part about bonds and treasury bills, if you plan to hold it to maturity, is that they give you the duration upfront for the maturity of the product, which means you can plan based on the duration of the maturity. So say you are 60 and you're planning to retire at 65, you decide to go for a low risk investment. This could be a good idea for you, because at 65 you get back the money, plus you earn some interest along the way without worrying about the volatility, assuming you go for a country or corporate bond with a good credit score. Usually it's correlated to the monetary policy of the country of issuance, because in general, the government is going to pay you for its bond or treasury bill based on what the treasury yield is. Similarly, for corporate bonds, usually is at or above the interest rate of whatever the monetary policy of the government of issuance, country of issuance is. Zero risk if issued by a country or company with a history of stable governance and a high credit score with good financials that is not going to go bankrupt. And there's guaranteed value and interest at maturity, if held to maturity, as long as the issuing institution remains solvent. So the variable used basically depends on the risk. So usually credit rating is inversely correlated to the yield. So the higher the credit rating, which say the safer the bond, then the yield will be lower. The lower the credit rating, means to say the higher the risk of default, the yield will be higher. So basically, as with all investments, high risk usually brings higher reward. So thank you for watching. I hope this was informative for you. Like I said, if you are young, say 35 and below, this is probably not one of the best investments for you. I will go with a savings plan that can let you roll over the interest, so that the compound interest can work for you, and you can easily get 5 to 6% without any worries whatsoever, or for your investment or for the issuer defaulting. But if you are, say, above your 40s, or even in your 50s and 60s, buying a bond or treasury bill from a highly rated or safely rated company, fund, or country will probably be a good part or a good investment for at least a portion of the capital you intend to put in into securing your retirement funds. So thank you for watching. I hope this was informative, and I'll see you in my next video.